Holy flippity flip flop flap and smokes, everyone. The Federal Reserve has done it. They've just crashed the market. Everybody was waiting for the Federal Reserve pivot. They were hoping they were going to U-turn. But people, I tried to warn you that this was just a bear market rally and there's absolutely no reason for the Federal Reserve to pivot whatsoever. I was saying the market is just hoping the Federal Reserve will pivot. They're living on a prayer, but you can't invest using hope or speculation. You have to follow the data. And all the data were telling us that the data is actually getting worse and the Federal Reserve actually has to get much more aggressive. So everyone, in today's video, we're going to go over why the market tanked today, what new language the Federal Reserve is saying, and what their new report is saying that is sending investors so scared right now. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, look at this, everyone. Dow closes 500 points lower. Nasdaq sheds 3% as Fed Chair Powell signals intent to continue hiking. As we'll go to the indices now, the Dow down 500 points, as you can see here, 1.55%. S&P down 2.5%. Nasdaq down 3.3%. With the Russell down 3.3% as well. We can see here Brent crude is still surging, is now $95 a barrel, and I expect after the midterms it's going to keep getting higher. Also, the 10-year US Treasury yield is now rising again at 4.09%, and I expect this could hit 4.5% very soon. Bitcoin didn't react as much to this news. I thought it would react a bit more, just down 1.5%. And if we look at the DXY, the dollar index, it actually plummeted before the news. But then after the meeting, it started surging higher from around 110 all the way up to 112. Now, whenever the dollar goes up, that's when assets go down. But when the dollar goes down, that's when assets tend to go up. So the markets are very worried because what the Federal Reserve had to do is he had to give the markets a spanking. What happens is when markets rally, that creates financial conditions to loosen. The Federal Reserve doesn't want this. He doesn't want rampant speculation where stocks are going up 20-30% in a month, because that's doing the opposite of what he's trying to do. He's trying to tighten financial conditions. He's trying to cool the speculative bubble that has been surging and created inflation over 2020 and 2021. But again, this market is continually trying to time the Federal Reserve pivot before it happens. So everyone, let's now get into what Federal Reserve Jerome Powell exactly said that is worrying the market so much right now. So everyone, it is official. The Federal Reserve approves a 0.75 point hike, and it takes rates now to the highest level since 2008 and hints at a change in policy ahead. Look at them. They're still trying to play the same game. Oh, they're hinting at change ahead. Well, of course there's going to be change ahead. What are you thinking, everyone? Because he's going to say, well, the Fed said he's going to eventually stop. Yes, of course he'll eventually stop. But when is that? Now? 6 months from now? Nobody knows. But you know what, people? Even if the Federal Reserve does pause with lifting interest rates, the damage is already going to be done. We've taken interest rates from 0 to 4%. The 10-year has gone from 0.5% to over 4%. That's an 8 times increase in interest rates. Now, many people will say, well, you know what, back in my day in the 80s and 90s, we had interest rates 10, 15, 20%. Yes, but debt was much lower then. Debt to GDP, or the US government debt to GDP, was around 30 to 35%. Consumers had a lot less debt because there was that thing where you don't want to take on debt because interest rates were so high. Well, the opposite has happened over the past 10 years. People take on debt because interest rates are so low, inflation will erode away the debt. Well, we're about to see a huge paradigm shift as interest rates soar back to the levels we saw in the early 90s. So the new language read, the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficient to be restrictive to return inflation to 2% over time. Now, people, what I've been telling you over and over again, I've been saying once inflation gets to these levels around 8-9%, it takes at least 5 years for inflation to go back down to 2%. So all these analysts, all these economists saying, well, inflation's just going to crash. It's going to drop to 2% next year. No, people, this is going to take years to play out. On balance, Powell dismissed the idea that the Fed may be pausing soon, though he said he expects a discussion at the next meeting or two about the slowing the pace of tightening. Now, again, something people need to understand if the Federal Reserve slows its rate hikes, it doesn't mean it's pivoting. For example, it may say, okay, at the next meeting in December, we're going to do 50 basis point hikes instead. But what really matters is, at the end of the day, not how fast they'll lift interest rates, but what interest rate they're going to get to, or what interest rate they're going to need to get to stop inflation. For example, they could hike interest rates to 5% at the next meeting, but then if they stop that, it would actually be more bullish than if they did 0.5% hikes or 2.5 percentage hikes, and then they lifted interest rates to 6 or 7%. That'd actually be much worse than the Federal Reserve doing an aggressive rate hike of 1% to 5% and then stopping. So all these people thinking that the Federal Reserve slowing their rate hikes is a pivot. No, it's not, everyone. And again, not just lifting interest rates, they're doing quantitative tightening, which they've never been able to do without causing a huge market crash or something to break in the financial system. We also reiterated that it may take resolve and patience to get inflation down. We still have some way to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Wow, so that's a huge one, everyone. He's saying now that the data's coming in, and this is what I've been saying, is still red hot. It's still good data for the economy, or better than expected, but inflation data is actually worse. So he's now saying, well, guess what? We're now going to have to lift interest rates higher than we expected. And what they go on to say is that they're going to have to lift interest rates higher than 5%, which is what I've been talking about. A lot of people said, no, they'll stop at 1%. Then they said they'll stop at 2, 3, 4%. I've been consistent people have been telling you they're going to have to go minimum at least 5%. And what they normally have to do throughout history is get interest rates above the inflation rate. But they won't admit that because they don't want to spook and crash the markets. So you see, every month they kind of just massage the market, go, oh, okay, we're just going to go a little higher. Oh, okay, next meeting, oh, yeah, maybe just a little higher because they don't want to cause panic. But do you know what will help you not to panic? Our sponsor today, Tendies, and their data. We're all aware that in 2020, the difference between success and failure is information. That's why you're watching informative channels like myself, and that's why I need you to check out Tendies app on iOS and desktop today. With the Tendies app, you get the first real attempt by any major publisher to integrate trading tools into a social media platform. And that social media platform is none other than Reddit. And this app was inspired as in pre-GameStop and the Wall Street Bets movement. Look at this, they have options flow, ticker details, a curtailed investment feed, tailored to stocks in your portfolio, and rooms where you can talk with other users about any publicly listed stock. Because I think surrounding yourself by like-minded individuals is one of the best ways to succeed. I personally love the filtered order flow. You can see whale purchases, a ranked chart of bid and ask spreads, and overall flow sentiment for free. I was talking about how Elon Musk buying Twitter could affect Tesla, and you can see the options flow data in real time right here. And you know what I think is the best thing is companies like Unusual Whales are charging customers $40 to $350 per month to give you the same information that Tendies is giving for free. And once you connect your brokerage, due diligence is all in one easy place. So filter out the noise and use Tendies. I absolutely love it. Make sure you click the link in the description and start taking advantage of this market chaos. So everyone, the soft landing path is starting to narrow. The chairman also expressed some pessimism about the future. He noted that he now expects the terminal rate, or the point when the Fed stops raising rates, to be higher than what it was at the September meeting. With higher rates also comes the prospect that the Fed will not be able to achieve the soft landing that Powell's spoken of in the past. So that's right, everyone. The Federal Reserve is submitting it. We're going to cause severe economic pain. And there's just simply no way around it when inflation is this high. You absolutely have to destroy demand, especially when there's so much issues on the supply side. But so far, the economy is holding up better than expected. We got the latest GDP figures. GDP grew at 2.6% in Q3, but again, GDP growth is still pretty much zero for the whole year. Unemployment's still at record lows, and what they're saying, well, look, they're spending on their credit cards, retail spending is up, but again, that's only up because of inflation. In real terms, I think the consumer is getting weaker, but they haven't hit their full-on breaking point yet. Has it narrowed? Yes, he said in response to a question about whether the path has narrowed to a place where the economy doesn't enter a pronounced contraction. Is it still possible? Yes, he said. That's right, everyone, because even though they didn't want to officially admit that we are in a recession this year, well, I think 2023, once each interest rate hikes start to have an impact on the economy, because remember, it can take 6 to 12 months before we see the full-on effect, before we reach peak pain with these interest rate hikes. And again, he's still raising them so rapidly, we haven't had time to see how this is going to affect the economy. We've got many, many more rate hikes to go. I expect next year when they hit 5%, they're still going to have to go high if inflation doesn't come down. And guess what? They could have to go to 8% if inflation keeps on surging higher and higher. Something nobody's talking about and something nobody's paying attention to. So GDP did rebound 2.6% in the third quarter, largely because of an unusual rise in exports. At the same time, housing demand has plunged as 30-year mortgages have soared past 7% in recent days. Now, quickly, something on the housing market is, I think the housing market is what's going to lead us into recession once the housing market does crash, because that destroys people's wealth. And there's something called the wealth effect. When people's stocks go up, when people's cryptocurrencies, home values go up, they tend to feel more wealthier and more willing to spend. But as that crashes, as all that equity wipes out, some people own a house worth, $2 million. They could lose hundreds of thousands of dollars in 6 to 12 months while they're going to tighten their belts. And again, like I said, the federal funds rate could go to 8%. Well, I think it's very, very possible we could see mortgage rates hit double digits, 10% next year in 2023. And that's going to be absolutely catastrophic for the housing market. Now, again, I'll try to warn people about this bear market rally. The Dow Jones Industrial Average has gained more than 13% over the past month, in part because of an earnings season that wasn't as bad as feared, but also due to growing hopes for a recalibration of Fed policy. So yes, while the companies in the Dow did do much better than expected, we saw the tech wreck during this earnings season. These tech companies are absolutely bleeding cash right now, and I expect this is only going to get worse in Q4 and Q1 in 2023 as these higher borrowing costs really start to hurt consumers. Plus, on top of this, what a lot of companies have been doing over the past 2 years is something called share buybacks. Debt was so cheap, pretty much 1%, so instead of investing in their company, buying equipment, building infrastructure, all they did was, you know what, we can get debt at 1 or 2%, we'll just buy back our stock and bank a 7 or 8% average return. But once interest rates start going above 7 or 8%, that won't make sense anymore, and you're going to see less company buybacks, and that's what's really going to send the market tanking as well. So what is the market saying the rates are going to have to go to? So current market pricing also indicates that the Fed rate will top out near 5% before the rate hikes ease. So everyone, I know you're thinking, well, okay, what does this mean for the markets and where are we heading here? What this means is, everyone, stop hoping and praying for the Federal Reserve pivot, stop speculating, wait for the data to change. We need to see pain in the economy, we need to see pain in the jobs market, and we need to see inflation come down substantially. More like coming down to 4%, not dropping, 0.1% or 0.2%. We need to see a big drop in inflation. Now, again, what many people are going to get wrong is when the Federal Reserve stops lifting interest rates, they're going to think, okay, everything's fine now. It's time to go all in the markets. No, people, again, these interest rates are going to take time for it to flow into the economy. So these interest rate hikes, if they stop at 5 or 6%, they're going to cause pain for the next 12 to 24 months. So like I keep saying, my plan hasn't changed. I don't change when I see, the markets turn green. A lot of people are saying, oh, Michael, you were wrong. Look, the market's up this week. Again, people, you can't just change your investment strategy day to day, because all simply is algorithms trading day to day. There's no real substance, no real meaning if the market rallies or goes down one day. Again, my plan to start dollar cost averaging back in is waiting for the S&P 500 to fall from its peak to its trough down 35%, because that's been the average bear market decline. But again, this strategy is flexible. When we get to that level, I'll have to look at the data and make my decision on how heavy I'll be going in. Maybe I'll just go in 10, 20, 30% if things I think are going to get worse, or maybe I may put more money in if I think this really is the bottom. But everyone, what do you think? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.